And we've got George Glennis from ETF. Welcome.
Thank you.
I'll start with you, Tendani. His favorite word in his speech, however.
Yes, I picked that, and I picked a theme as well. Load shedding is going to be, it's a problem, has proved to be a problem. Some of the data that has come out, and they're factoring it into uncertainty in exports, because you can't say that you're going to export this much or commit to a certain figure if you don't know how much you're going to produce. So those, however, and the theme in load shedding as a problem for this economy, both for consumers, for businesses. What he omitted to say was that also for investors, the perception about South Africa as a favored destination for investment. If you can't get that basic thing right, it's a problem for foreign investors. It's a problem for us as people who have commitments to fill up orders. If you don't know whether it's going to be 2.5 hours this week or the system is stable, the whole week you'll be producing. So I think for me that was a theme that came up. And the fact that because of that we won't be fully able to take advantage of other factors that are favoring this economy. We have seen a moderation in food prices, which has factored into inflation. We have seen a moderation in transport inflation coming from the lower oil price. The rand remains sensitive to perceptions about South Africa, particularly about load shedding, among other things. So for me, that was a theme that came out, and I'm happy that the governor put an emphasis on that.
George, the big but for you.
No, I think, if anything, he went to and fro so many times. You mentioned the word however. I mean, the point to take out of that is that they had so much to discuss, so much to deliberate. It almost proves to a person how impossibly difficult it is to plan an interest rate in the way that central banks do these days. So, when you consider oil prices through to disinflation around the world, you've got wars in some parts of the world, you've got changes in government in others, you've got manipulated exchange rates in some quarters, and in others free floating or moving to free floating as happened in Switzerland. There's just so much to assimilate, on top of which you've got domestic factors such as your load shedding, such as our own labour market issues and structural rigidities. And you ask yourself, how on earth is it possible for a team of, it doesn't matter how big, because we can see quite clearly from their forecast that they produced in December, no one foresaw the oil price dropping off in the way that it did. And yet they're expected
no one on the planet.
And they're expected to make pronouncements on interest rates. Now things have changed dramatically. I think they're going to be behind the curve on this one. So I think what's happened in the oil price is a lot more rigid than I think they perceive it to be. But be that as it may, I think that will unfold through the course of the next couple of quarters. But for them to take these decisions, there was so much to take into consideration this time that I think they just sat back and thought, well, the best thing to do, when there's so much to take into consideration, is actually just do nothing and let's just watch the chips fall as they may.
Do you agree that there's too much risk in the system?
There is risk in the system, definitely, some of which the governor has highlighted. While he does speak of the risk being on balance, I do think that there's risk. For South Africa itself going forward, the domestic factors, we hope that labour unrest has settled. We're not going to have that going forward. You might remember that part of the reason why growth was slowed drastically from the initial forecast, both by Treasury and the MPC last year, partly had to do with the protracted strike in the mining sector and the manufacturing sector. It's too early. It's early days now to tell whether that's going to be a factor or not going forward. I don't think there's an issue insofar as domestic demand is concerned, that putting pressure on inflation, because I believe that domestic demand is going to remain weak. We have a household sector which is highly indebted, which doesn't have any savings to fall back on to pump up expenditure. So I don't think there's any risk coming from the domestic side. But from the international side, while they didn't foresee the drop in oil prices, I think what is going to bother them is the volatility of the rand. So there is risk in the system.
To me, it sounds like whilst Europe has to worry about deflation, Japan continuously so, we have to now start worrying about disinflation.
Yeah, well, I don't think there's anything to worry about, to be honest. Quite honestly, if I had a choice, I'd prefer to have lower price increases going forward than higher price increases. To my mind, low inflation is not a problem at all. In fact, it would assist matters a great deal. That price stability is something everybody strives for. It's extremely difficult to generate when you've got credit systems that aren't sometimes presided over by the central banks in the manner that they should. And when there's too much debt in the system, you can see what the effects of that can sometimes be. You get things like this disinflation and deflation in some parts of the world because, quite honestly, it was unsustainable to begin with. And that's the problem with a lot of this central bank activity that we've seen. And this isn't something new. It's been going on for many, many years now. I would argue that it's part of the reason why we landed up in the crisis in the first place. All that to say that low interest rates in and of themselves are not going to fix this problem. The problems are structural and they relate very primarily to debt. And we need to be tackling issues of debt if we're going to tackle a stable and look for a stable price environment long term.
Let me interrupt you there and ask Tendani, do you think a cut would have helped us out, considering what George just said?
A cut certainly always helps in the sense that it's easier to borrow, and presumably businesses are going to borrow to invest and build up capacity for the future. But we have to remember that in this economy, we already don't have enough savings. So it's good for those who are in debt and those who are hoping to borrow money in order to invest. But for people who rely on capital income flowing in from savings, it becomes part of the problem. Yes, the majority of the population would benefit. But my problem with that as an incentive for, say, consumers to spend more, we already rely too much on credit to finance expenditure, current expenditure. So the high debt levels are not going to come down because interest rates have been cut. We've had several cuts and we're still over 70% as percentage of the household disposable income. The problem is if you're not going to address some of the issues like creating real employment, increasing household disposable income sustainably, you're going to have those high debt levels. So for me, for this meeting, I don't think they should cut, even if interest rate remains low for the rest of the year. I'm not for a cut.
Okay, we'll revisit that after the break. Don't go away.
People, we are getting there, and thanks to you, Pati is set to become our country's 12th official language. Here's today's word. Substitute, replacing a drinking buddy with somebody more fun.
That has gone out of the ballpark.
That's more like it.
Help make Pati South Africa's 12th official language. Sign the petition today.
I've got a credit card.
Welcome to your world on SABC News Channel 404. I'm Tabile Ngwato.
And I'm Lulu Gabu.
President Uhuru Kenyatta says he will attend the status conference for his crimes against humanity case, but in his personal capacity and not as president of Kenya.
Judges insist he attends this status conference.
About 50 Kenyan MPs are expected to travel to The Hague to express solidarity with President Kenyatta.
The Kenya cases have really tested the International Criminal Court in ways that it hasn't yet been tested.
Your World, weekdays at 9 p.m.
Welcome back. Well, the MPCs decided to keep interest rates where they were. So let's find out some more about the decision. He's rattled off a lot of numbers when he was speaking. Was it actually necessary? I'm thinking about our viewers. You hear so many percentages and it just goes over your head. If you were to sum it up in 2 sentences, what would you say?
In 2 sentences, inflation is going to be dropping before it stabilizes and maybe goes back up, and growth is going to remain constrained. Those are the 2 sentences. So they are They are very sensitive to the growth and employment dynamics, and therefore they're keeping rates unchanged. I mean, that's the MPC statement summed up in 2 sentences for me.
Do you agree?
Yeah, I agree. But I also feel that in terms of keeping rates unchanged, which I said earlier, it's the right decision for this meeting. Part of the stimulus, hopefully, that might start filtering through to consumer pockets is the fact that despite a weak rand, the low oil prices are resulting in some real cash in consumer saving, which they can use to reduce household debt and stimulate spending, so to speak. I do think that my take from this MPC is that growth is going to remain subdued. I don't see unemployment rate coming down in the near future. So we should really rather use the stable interest rate environment in the short term to plan appropriately for business support growth going forward. How that pans out practically is hard to say, but I mean, for me, it's the muted growth rate going forward that is of a great concern.
Is it going to become even more muted once Janet Yellen raises her rates?
If she raises her rates. There's big question marks about that. We very firmly believe that this tighter liquidity environment and some of the headwinds that are happening around the world is going to limit the scope and the extent to which the Fed is able to normalize their interest rates, if they can at all. So already we've seen...
What do you mean if they can?
Well, if they can. I mean, we focus on a lot of the numbers in the here and now. So there's a lot of focus on how strong quarter 4 growth was, and that's...
But that's the past.
That's exactly the point. It's the past. I would raise serious questions about whether they would follow through with a hike if they saw some of their numbers starting to lose momentum, or in fact even softening slightly as we go into the second quarter of this year. They could very well postpone that decision until quarter 3. Then the numbers continue to lose a little bit of momentum, lose some of their lust, and they push it out to quarter 4. And so this is what I'm anticipating is going to happen. If they do hike, I think it's going to be possibly 1 interest rate hike, maybe to just keep the markets, and appreciating that they are doing their best to try and normalize policy. But I don't know that policy stance is going to be sustained when your global economy and in fact your US economy has become so entrenched in requiring plentiful liquidity and ultra low interest rates to be able to generate the kind of growth that it has.
Tendani, let's go back to all these numbers. There's sheer amount of percentages that he quoted.
Yeah.
Kind of suggests to me that the MPC itself has got no clue. And they are really grappling in the dark here, and it seems that they decided to just, let's hold off, guys.
If you distill the numbers, Gunta, you'll see he talked about factors that they think are going to impact or to have an impact on the decision. Yes, I think they were taken aback by this direction. I think when they left in December, as you pointed out earlier, they didn't foresee the drop in the oil price, nor did any other person that I know of now globally. So it's not the MPC only. So they didn't foresee that. But the numbers that they have, the statistics that they have, they look at it as building up to a decision. You look at the short-term indicators, manufacturing, retail, whatever is going to build up to the GDP level, whatever influences household spending, whatever influences inflation.
Yes.
When you listen to all those things, it becomes too much. But for me, if they were to distill the fact that we think that GDP is going to be influenced by lower manufacturing, a bit of an improvement in mining, instead of saying it was 5.75, now it's going to be 4.28, it becomes confusing. But all those data is heading to a direction of either saying domestic growth is going to be a problem. We're going to have a problem in domestic demand, heating up inflation. Those high volatility indicators just indicated that on their own, yes, I agree, they don't seem to add value.
But now, you see, the irony is that the one number that he should have perhaps given us, he left out.
Yes, the forecast.
For the oil price.
Yeah.
What do you make of that?
I think they were taken aback. They are scrambling like everybody else and rejigging their model.
George, you agree with that?
Yeah, well, I think it shows the futility of forecasting and relying too much on forecasts to generate economic policy. I think this is part of the problem, is that we we don't necessarily understand monetary dynamics well enough, and I think more work needs to be done on that front. I think we place far too much emphasis on things like inflation expectations, when a lot of the time inflation expectations are more informed by what's happening currently than they are necessarily an accurate reflection of where inflation is going to go. For example, we know, and he mentioned in his speech, that inflation is going to be dropping to 3.5%, yet he was talking about some inflation expectations of 5.9 average for the year, which clearly tells me they polled an economist that hadn't updated their forecast, because there's no economist that I know of that's looking at an average rate that high, given what's happened to the oil price. So, you know, there's a lot I have a problem with in the way that monetary policy gets conducted with generally, not just in South Africa. It's a global issue. And the fact that we rely so much on these econometric models to generate us this crystal ball, this beautiful look-through that apparently answers all questions, and clearly it doesn't. And we get caught out repeatedly when perhaps there are other ways of being able to manage monetary policy that don't rely on a plethora of numbers, like as you quite rightly mentioned. There are so many data in here that for us to remember it around here, and bear in mind we work with this stuff, it's difficult enough, never mind for the man on the street. So I think there's a message in there somewhere, and that's that perhaps we rely too much on econometric models.
Okay, well, thank you for your time, both. We're out of it now, so time to say goodbye to the viewers. Well, savers, you didn't get what you want. A hike would have been nice for you. And those of you who are paying off your debts, you didn't get a cut either, but at least things are still a little bit manageable. So, with that said, don't worry too much about what the government said. Take care of your pocket.